Hello, and welcome to another edition of a Policy Brief. This is the weekly review, Policy Pulse. And I'll say August 1st is around the corner, and that's just not another day or date on the calendar. It's a looming deadline that could redefine global trade. And we also have on the show that we're going to be talking about stablecoins. They are finally getting a federal rulebook and some guidance. And I'd say it's a game changer. Some also might consider it, some sort of trap. And we also will talk about central bankers, what used to seem as they have like a united front. We're beginning to see that they're marching through different beats, obviously, due to cultural context in the country that they manage. We're also looking at Canada. They're going to be trying to shred decades of federal red tape in just 60 days. And big tech, they're facing massive fines on both sides of the Atlantic, but the real battle, for digital control, I'll just say is just starting. This is just the beginning. And the question for us is, are these all isolated headlines, or are we witnessing the chaotic birth of a new global economic order? And I'll say the most significant question when I consider the 5 topics that we're going to look at today is, are policymakers building a coherent framework for the next decade? When you look at different things that we're going to talk about in terms of trade policy, regulatory policy, and the likes, or are we seeing the locking of the global economy into what some will consider a patchwork of conflicting rules that raise the cost, for businesses and will slow growth? So let's, dive deep into the 5 turning points that will be shaping our future from a policy perspective. Our first topic today will be the August 1st tariff deadline. We'll be given an update. So let's get started with this. And I'd say this is sort of like the elephant in the room, and in this case, it will be the global trade room. The August 1st tariff deadline, for some, might even consider it a cliff, because a lot of countries are going to get hit with, tariff numbers that they don't quite like. So according to the U.S. Commerce Secretary Howard Lutnick, there will be no extensions, no grace periods. August 1st will be the date, and the tariffs are set. And according to the administration, it's not a drill. And from when this is being recorded, we are 4 days away from the most consequential tariff rollout since the 1930s, for the U.S. Now, what does this mean, for you or anyone, wherever you are? This basically says, according to U.S. trade policy, that the baseline reciprocal rate is jumping from between around 15 to 20% virtually on all imports. And you could do the math and consider what that means, because tariffs really are a tax. So for some it's even higher. For Canada it's a staggering 35%. For Brazil it's 50%, and 15% for the EU. For Brazil, you sort of have to consider, and I know President Trump did make some comments about, hitting BRICS members with some additional tariffs. So that's something to watch out for. Now, with these rates that I've mentioned for these countries, it pushes the blended US tariff rate to about above 20%. And that's a level not seen since, I believe, 1911. The Yale Budget Lab projects that these tariffs could rake in $2.33 trillion over a decade, and that's massive. It sounds like a win for the Treasury, right? But the stark reality is it could cut US GDP growth by 0.6 percentage points in 2025 alone. That's not too bad. However, it's concerning. And the average American household is expected to pay roughly $1,300 extra in 2025 due to higher prices. Now, overall, it appears, just to provide context, there's a strong push by the current U.S. administration to finalize trade deals and impose new tariff structures, with the August 1st deadline coming for many countries. And, one of the deals we saw, happen over the weekend was with the EU. And we see the general trend, like I mentioned, seems to be like 15% tariff for most goods for major economies. And I'll quickly, talk a little bit about Japan and the EU, because those are the deals that we sort of got not too long ago. and they're major partners for the US. Significantly lower, I talk about 15% being significantly lower than initially, threatened higher rates, between 25 to 50% for most countries. However, we've seen some sectoral tariffs, steel and aluminum remaining higher. So for Japan, we've seen a trade deal finalized. Japan is a major trade partner of the US. The US has finalized a trade partner with Japan. For the tariff rate for Japan, under this new deal, the US will impose a 15% tariff on most goods imported from Japan, and it's a reduction from the previous threatened 25% tariff rate that was set, to take effect August 1st, which is just 4 days from now. For Japan, what most people are concerned about is automobiles. Specifically, tariffs on Japanese auto imports to the US will drop from 27.5% to 15%. And the other commitments we see, Japan has reportedly committed to investing 550 billion in the US, with the US receiving 90% of the profits and opening its market to American autos, rice, and other agricultural products. Well, the people who, the thing with these deals is people sort of don't have a breakdown to some of all these, commitments. And that's something I believe will come, in the coming days and weeks. We'll be able to, vet, what implementation looks like for some of all these trade deals. Steel and aluminum remains 50% US tariffs on imported steel and aluminum from Japan, which will remain in place. Now, for the EU, the trade framework agreement that we got news of, I believe, was Saturday, Sunday. The US and the EU have reached a trade framework agreement, and the agreement sets a 15% tariff on most European goods entering the US, including cars, semiconductors, and pharmaceuticals. And this is significantly lower than the 30% tariff rate previously threatened by the US, which was supposed to take effect on the 1st of August. Now, we're seeing strategic products with zero tariffs. Both sides have agreed on zero tariff on a range of strategic goods, including aircrafts and component parts, certain chemicals, semiconductor equipment, some agricultural products, and natural resources. And details for adding more products to the list are still being worked out. We've also seen unchanged tariffs. That's like for 50% US tariffs on imported steel and aluminum from the EU will remain unchanged. And we'll also seen other commitments, sort of similar to what we had with Japan, where the EU has pledged additional investment. Now, but for the EU, the additional investment will be $600 billion in the US. And, there's also, included in this deal, purchase of 750 billion watt of US energy over 3 years. And, this is sort of a move away from dependence on, Russian energy. Now, we also seen further, the talk of, further approval being needed, especially from the EU, because the deal still needs to be presented to the EU member states and lawmakers, for approval. Now, basically, in summary, for both Japan and the EU, recently secured deals with the US, that sets a 15% tariff on most of their goods, sort of, averting higher tariffs that were set to begin on the 1st of August. However, extending higher tariffs on steel and aluminum, from both regions generally remains a problem. One also has to sort of consider when you're looking at the tariffs, because you sort of have to think, what's the critical reason here? What are the questions? So for me, when I see the updates on the tariff and trade policy, you sort of have to think, okay, so is this a revenue play, from the US government? And, we're seeing a lot of protection. So you have to sort of contrast between protection and, revenue. So tariffs are being pitched as a tax cut offset. But it's the same households that, would enjoy the lower income, taxes that will pay for the higher goods. Now, the policy's, fiscal neutrality claim, um, from a policy standpoint remains shaky at best, when half of the burden of the taxes will land on domestic consumers. Now there's also what and there's a word that sort of gets pushed around in policy circles, which is the vibes. There's sort of like a Great Depression vibes about the tax rate, because the average rates for for tariffs rather are approaching you know rates that you had when we had like the banking collapse in the 1930s, because we had a lot of protectionism going around then. So that risked you know having like a demand shock in the economy. So that's something that people are beginning to watch out for. And we also have like the legal sort of like landmine around the whole tariff situation. We have like oral arguments at the federal circuit on 31st of July, which will test whether the International Emergency Economic Powers Act is enough to impose across the board tariffs constitutionally. And then we now see with this rush for lower tariff rates, sort of a fragmented diplomacy landscape, with the EU cutting a 15% deal, while Canada is going to be hit with 35% come August 1st, and Japan securing 15% before August 1st. So we see sort of like a piecemeal approach, which undermined or has undermined or seems to undermine the multilateral coordination among nation states when it comes to trade. And it's created a scenario where you sort of have increased uncertainty regarding global trade. Now, rounding up the tariff update, the policy question here, when you consider all that's going on, is if tariffs have become sort of a perennial revenue tool for the US government, how does Congress maintain any credible ceiling on future protectionism or deficits? And one has to then now consider, is this just about trade, or it's about the future of fiscal responsibility? And I think that's something that we have to consider on the topic or discussion of tariffs. And we're moving to our next topic, which is the Genius Act and the digital dollar gambit. So crypto is experiencing a new era, and we're transitioning basically from trade wars to talk of a new digital frontier. And on the 18th of July, President Donald Trump signed the Genius Act. That's the Guiding and Establishing National Innovation for U.S. Stablecoins Act. This is America's first federal crypto law, and it passed with strong bipartisan support, 68 to 30 in the Senate and 308 to 122 in the House. It's a rare moment of unity, I'd say, in what seems to be a divided Congress. And we sort of have to ask the question, what does the Genius Act do? And I'll do a deep dive in this hopefully this week. It establishes a clear framework for stable coins. Stable coins must be 100% backed by dollars or treasury, and they are explicitly not securities. And this was something that we sort of had. That was a problem with in the crypto space, where the SEC sort of was doing regulation by litigation, really, and going after crypto in the sense, and making everything a security. So this sort of provides guardrails for crypto. And so stable coins are not security. It also introduces a dual supervision model. Smaller issuers can opt for certified state regimes, while larger players fall under the OCC or the Fed. And crucially, it takes or rather it bakes in full bank secrecy act compliance and freeze and seize capabilities, thereby extending US jurisdiction directly into the code of these digital assets. Now, people have questions, people have what they deem to be flaws, but what I do like about this is, it's for the first time provided guidelines. So this is what you need to do, and whether the guidelines um, meet all our expectations, well, that's yet to be seen. However, you do now know what's expected of you when you're dealing with stable coins or crypto. And one can only say that, well, it gets better from here. Now, I would say what's also good about this is the timing is quite strategic, because as China, pilots its own retail digital currency, the US is, deputizing private issuers to extend the dollar's global reach. Now, it's sidestepping the gridlock, on the Fed issued digital dollar, which will be the CBDC, which a lot of Americans don't quite like. And, it's good. They're exploring other options, and it's this mandatory treasury backing. Also turbocharges demand for U.S. Debt, reinforcing the dollar's reserve currency status, even as deficits grow. And there's a lot of talk about BRICS. It pushes dollar dominance further along, and it also aims to solve regulatory arbitrage, replacing what would have been 50 state patchwork for crypto, with a clear federal on ramp for stable coins. And it comes with a built-in freeze function. Dollar stable coins now then becomes instantaneous foreign policy levers, making them sanction ready. Because we've seen how the US in the last decade have they've used things like Swift, and the likes, as an extension of foreign policy. So the freeze function ensures that they can do that. Now for the stable coins, the main policy question that I sort of have, when I consider this, and this is separate from my deep dive that I will do, is that you have to ask, will other jurisdictions, other countries embrace um, compatible standards to what we've seen here in the US, or will they, erect, digital walls, that fragment cross-border payments? Because stablecoins typically enable and make cross-border payments quite seamless. So you don't have to consider will other jurisdictions or countries sort of embrace what the US has done, and becomes sort of a smooth sailing system, or will they erect data walls that would fragment cross-border payments, leading to what some have described as a balkanized digital economy, which is very different from what stablecoins are supposed to, to solve. Okay, so our third topic today is central bank divergence, what some have characterized as the great monetary split. And this topic really covers what some believe is a seismic shift in global monetary policy, and that's why we have the term central bank divergence. Now, the post 1990s norm of synchronized easing or tightening, some believe it's over. Now, we see each major central bank now fighting nationally specific shocks, which ultimately complicates global capital flows. And we're seeing central banks like the Bank of Canada, the Fed, the ECB, all struggle with um having that regime where they all sort of tighten at the same time and ease at the same time. All right, so we see the Bank of Canada held its rate at 2.75% twice, citing unusual uncertainty from the US tariffs as the chief reason or the main reason. And this is a rare admission that foreign fiscal policy is now steering domestic rates. Their own analysis attributes two-thirds of recent Canadian dollar weakness to tariff uncertainty. And it's limiting their room for further cuts without foiling or increasing imported inflation. Meanwhile, the Federal Reserve is expected to hold rates at 4.25 to 4.50% this week, despite pressure from the White House. The EC, the European Central Bank, they cut rates to 2% in June, specifically to cushion the fallout from those very very same tariffs. But this isn't just a minor disagreement, it's a fundamental split in monetary strategy. We're seeing what some will consider as institutional strain, and we might even see the first dual governor dissent for a Fed rate cut since 1993. I mean, it's underscoring the intense political pressure on central banks. We've seen reports where President Trump, is sort of flirting with the idea of, firing the, Fed chair. That raises questions, for central bank independence, which is ultimately very important when you consider monetary policy. So the main policy question here will be: can central bank independence survive when trade and physical shocks dominate inflation dynamics? Or will we see politics reclaim the steering wheel, for monetary policy, leading to less predictable and potentially less, effective monetary policy? And I'd say, like, which is knock-on effects on the global financial system. So I think that's something for us to ponder when we are observing the divergence in central bank rates, with major central banks, and the effects of central bank independence, considering the pressure from government to lower rates. Our next topic would be Canada's 60-day red tape review. Some consider this stimulus by scissors. It's quite interesting, and I do quite like the approach that Canada has taken. So Canada has launched a significant initiative aimed at stimulating its economy through deregulation, and rather than traditional fiscal spending, which I think is important. So on the 9th of July, Ottawa initiated a whole of government red tape review, requiring ministers to identify and report on outdated or duplicative regulations within 60 days. I think this is quite impressive if they can pull it off. So this rapid timeline is quite unusual for government reviews, because typically we know governments to take time. Now, the key aspects and cost of the regulatory burden that has necessitated for this is there's a staggering compliance cost. The annual cost of regulatory compliance for Canadian businesses is estimated at $51.5 billion, and of this, $10.9 billion is specifically attributed to just pure red tape. So we now have the impact on small businesses. So like there's a disproportionate impact on small businesses. So basically small firms bear a heavier burden. They spend 5 times more per employee on compliance, than larger or large corporations. So the time spent on compliance is also a problem, because businesses collectively spend an estimated 735 hours. That's equivalent to 92 business days annually on compliance. So what's the rationale and the potential impact for this particular red tape review? There's focus on economic stimulus, with federal finances constrained, especially with the tariffs that are coming from the US. Ottawa is banking on the regulatory productivity gains to boost GDP. Especially basically trying to be effective, by substituting paperwork cards for new spending. And I think that's quite innovative. So they're also trying to address low GDP growth. The initiative aims to tackle Canada's projected lowest per capita GDP growth, and I believe this is by the OECD. Canada is projected to be the lowest per capita GDP country among advanced countries, through 2060. So by identifying red tape, as a controllable drag on the economy, I think it's their way of addressing that low GDP growth that the OECD has sort of, forecasted for Canada. Now they're also targeting micro enterprise bottlenecks. The political and economic payoff is expected to be greater if reforms focus on easing the burden on small and micro enterprises. You sort of have to, consider what are the challenges and policy questions, with this particular policy initiative. There's the risk of inaction. There's a concern that without sustained ministerial follow through, this this particular review might just be another unacted upon government document. And that's something that's important. You want to see what's how was this for what's the follow through on this. Want to see implementation, and you want to see a follow through process continually, or else this sort of gets lost in the weeds. So there's also concern for deeper structural changes. The fundamental policy question is whether rapid regulatory pruning alone can deliver measurable productivity gains, or if meaningful reform necessitates deeper structural changes, particularly addressing the complex federal provincial overlap inherent in Canada's unique federal system. Our fifth topic will be on digital markets, and it will be a focus on transatlantic convergence and conflict. So, finally, let's take a look at the digital battleground, where we're observing transatlantic powers, basically the EU and the US. There's a convergence, of policy, and there's also some clashing. I think it's something that we can, share some light on. So in April 2025, the EU levied massive fines under its Digital Markets Act, 500 million euros for Apple, 200 million euros for Meta. These are massive fines for Meta. And in June, a 329 million fine for food delivery firms in the EU's first labor market cartel case. Now, meanwhile, in the US, the DOJ monopolization cases are targeting the very same firms, mirroring, the EU's theories. Despite, the tariff battles that, seem to have come to an end now with 15% tariff, for the EU, Brussels and Washington, are prosecuting similar abuses. And, it's indicating sort of a de facto alignment of antitrust norms. So, however, the EU's competition chief, Teresa Ribera, has declared that the DMA rules are not negotiable in tariff talks, prioritizing regulatory sovereignty over trade peace. This obviously, highlights fascinating tension. And one, obviously we'll get to know more about the details of the trade framework between the US and the EU. One would like to, sort of fact check to see if regulatory sovereignty won at the end of the day over, trade peace. The AI, wild card is also in play because the DMA review explicitly asks whether new obligations are needed for AI-powered services. Signaling that the rule book will evolve with technology. Yet, even amidst these clashes, the EU and US Trade and Technology Council, the 10 working groups, keep dialogue alive, on standards and supply chain security. It's a complex dance of cooperation and competition, and considering what's going on one side of the Atlantic and the other side between the EU and the US in terms of antitrust norms, the policy question for me when I, look at what's going on is, can the West sustain unified tech governance while waging a tariff war? Or will, fragmentation hand strategic advantage to rivals? Some might say they are authoritarian or whatever you want to call them, but will this fragmentation, with tariff wars, hand like the advantage to your rivals, who are eager to take, the stage or center stage and come up with their own form of digital norms, that you might not necessarily have, the same regulatory sovereignty that you have right now to, to impose certain fines, because you'll be playing catch up. So I think that's where one sort of has to start thinking, ahead, with all that's going on with tariffs globally, and how it's shaping, trade internationally. As always, the topics we've covered today are seemingly not always isolated. We've covered topics on tariff, updates on the August 1st tariff deadline. And we've also covered the crypto regulation, that's the Genius Act. And we've also covered divergent monetary policies by major central banks. We've looked at, deregulation drives. We've covered, digital antitrust implementation in the EU and the US. These are all unfolding simultaneously and interacting in unpredictable ways. We've looked at, tariff-induced inflation that may force central banks to stay hawkish, even stable coins that are somewhat deepening global dollarization rather. And we've also considered Canada's red tape cuts, could attract investment, just as US tariffs are, diverting supply chains globally, and what a tougher EU DMA implementation might look like, in terms of leverage for or a bargaining chip as trade talks evolve with the US. And The ultimate policy question, when we consider all that's happening, all that we've talked about today, is democratic governments rather agile enough to coordinate across trade, money, regulation, and technology before the feedback loop of some of their own policies trigger what some might consider the next economic shock, given all that's happening in the world today. And the call for action that I'd like to end with is, given all the 5 topics that we've covered today, which one do you believe will matter most 5 years from now? Drop your analysis in the comment section. And if you value, deep dives like this, that cover weekly global policy issues, that cut through all the noise, hit the subscribe button and let us know what you think in the comment section. I am Aaron Marcella. See you next week as we track the fallout from the August 1st tariff deadline. And, Bank of Canada's rate decision with the Fed and all fun stuff that have to do with policy. See you.